Okay, guys, now I actually want to talk about the inversion fair value gap. Inversion fair value gap is basically a manipulation. So the underlying logic of inversion fair value gap is that the market is being manipulated, and I actually want to show you a video that you can watch. And this is something I'll actually show. I'll actually send you in the group. But it's a video about a hedge fund trader, famous hedge fund trader, explaining how hedge funds and large institutions manipulate the price. I'll just play the start for you guys to understand.
Welcome to Wall Street Confidential. I'm Aaron Task, joined again by Jim Cramer. Jim, welcome.
Good to see you.
Thanks for being here. There's a lot of economic data out today, but I want to talk about something else first. Again, today we have the misdirection from the futures. The futures pointing to an up market, and as of right now, stocks are down again. Is this just because it's the holiday period that we're seeing this?
You know, a lot of times when I was short at my hedge fund and I was positioned short, meaning I needed it down, I would create a level of activity beforehand that could drive the futures. It doesn't take much money. Similarly, if I were long and I would want to make things a little bit rosy, I would go in and take a bunch of stocks and make sure that they're higher. And maybe commit $5 million in capital to do it, and I could affect it. What you're seeing now is it probably is a bigger market now. Maybe you need $10 million in capital to knock this stuff down, but it's a fun game and it's a lucrative game, and you can move it up and then fade it. That's often creates a very negative feel. So let's say you take a longer term view intraday. And you say, listen, I'm going to boost the futures, and then when the real sellers come in, real market comes in, they're going to knock it down. That's going to create a negative view. That's a strategy very worth doing.
Okay. So yeah, the link will be sent in our trading group. But basically, what it is okay. Let's say that the institutions and the bankers, since this is their working window, right? They want to drive price lower so they can buy cheaper, right? So how they would trap retail traders is basically by firstly making the price go up. So anyone who sees this, they can be thinking, okay, we are reversing from this level. And actually, I want to show you this. This is actually quite interesting because for retail traders, what they would do, let's go to 5 minutes. For retail traders, what they would do is something like this, right? They would have this kind of stuff on their chart. So this is the trend line that your usual retail trader trades, right? So when we trade here, what they see is support because of the trend line. So a lot of people would be like, okay, we are buying and we are going higher, right? But what this actually is a fake move. And why is the fake move is actually because I told you guys to study the first fair value gaps that present during the silver bullet time window. So this is the first fair value gap that presented itself during the London session, silver bullet. And it's always either going to act as a support for price or it will become an inversion fair value gap to act for as a support for price in a different direction. And yeah, this move here is basically what the guy was talking about in the video. So if they want the price to go down, they would make things looking rosy, right? So they would try to make things looking like they are bullish so they can trap other people. And fair value gap basically means that there is a lot of volume coming in money wise, right? So this is the fair value gap. So you can see, for example, if an institution enters with a really high volume, like a 5 million, 10 million, like the guy said, they would move the price, right? Because why? They would take up a lot of liquidity, right? Because usually, like a retail trader, me and you, we are selling just small lots, small units, but for them to be able to buy in like 5 million or $10 million, they have to move the price, right? Because there's not enough liquidity here for them not to move the price. Okay, so once they move the price, they trap a lot of people who are going for buys, right? Um, for obvious reasons, for example, the trend line here, or maybe they identify this as an order block and they buy. And once that happens, what we are doing is we are just waiting to see how price reacts from this, right? So if this was a true bullish move, um, this BC here would be respected by the candles, and we would potentially see something like this, right? We would have to break this CB, and then it would be inversion fair value gap again, and from there we could go higher. But this is not the case. We can see that the price breaks this down, and once the price breaks this BC, that's when we get the confirmation that this is an inversion fair value gap, and also we get the confirmation to sell because this is another market structure shift, right? So yeah, this is the logic behind the inversion fair value gap. If there is anything that was hard to understand, you guys can always message me. And yeah, happy trading. See you later.